Sheila, it's great to see you again. Welcome back.
Thanks for having me, Kelly. Nice to see you.
I appreciate that you are just coming right out and saying they should stop hiking now. What gives you the confidence to say that that's the right thing to do here?
Yeah. Well, I'm saying hit pause, not necessarily stop. But I do think, look, you have to look at where they started, which was near zero, over 4.25. That's a 6,000% increase. It's a pretty dramatic increase in borrowing cost. And we have an economy that's much more leveraged than it was back in the Paul Volcker era when he was fighting the great inflation. It was a different, I applaud their emulation of his courage, but I do think there's some different circumstances that need to be taken into account. So, yeah, I do think it takes a while for these increases in interest rates to flow through to the economy. We don't know the full effect yet. We're seeing some positive signs. I do think it'd be prudent to hit pause and wait several months and see what the impact is before they go further.
Do you think they need to pay more attention to things like yield curves and what the financial markets are telling them? I mean, should Chair Powell basically couch what he's saying in, yes, I know the CPI is at 7%, but I pay attention to these forward-looking markets, and they're telling us that we're going to be in a deep recession within maybe a year?
Yeah, well, I think you should worry about that. The yield curve is pretty traditionally has been a pretty good indicator, and the Fed's focused on short-term rates. That's another difference between now and the great inflation days. They're basically paying banks and other big financial intermediaries not to lend. So if you park your money in a reserve account or a reverse repo with the Fed, you're getting an increasingly higher rate, nice juicy returns. You do just risk-free. You don't have to lend into the economy anymore to earn a decent return. And I think that is a very powerful tool that they're using now that they weren't using back then. Another reason to stop and pause and evaluate the flow-through effects before they go further.
Yeah.
But talking about the yield curve, this puts tremendous pressure on short-term rates, which is why I think you're seeing these very significant yield curve inversions over the past several weeks. And that, yeah, he should be troubled by that.
So what happens if they don't pause right now, do you think?
Well, it depends. If they do another 25 basis points the next time, maybe that's okay. I do think there are fragilities in the system. I cited the elevated levels of debt we now have in our economy, but that doesn't even count the tens of trillions of debt you're not seeing. Liabilities that are based on derivatives exposures that are off balance sheet that reside in the shadow sector. Another difference between now and back during the great inflation days. So I think they need to see, look, I don't have private funds take losses, fine. But all the college endowments and pension funds and others who have gone into those risky investments because they couldn't get a good, strong yield on lower risk investments, they could get hurt too. And that's another thing that I think argues for going slower.
How much? Because the blame game's already beginning, Sheila. As you know, we've seen politicians going after the Fed. The economy will probably go into recession. The finger pointing will accelerate. But to my intro at the top of the show, how much is, and not on one party or the other, because they both passed the original bills, how much was government spending, stimulus, PPP loans, et cetera, in your mind, responsible for the current inflation?
Yeah. So Washington has an inflation bias, and I don't think you can really have a clean separation between fiscal spending and monetary policy. The Fed bought trillions and trillions of federal debt. They monetized that debt. They don't say they did, but they really, in fact, did to feed all of that deficit spending that, yes, fed into inflation. So I don't think you can separate the two. Look, everybody wants to be a crowd pleaser, make it cheap to borrow, spend money, increase more subsidies, forgive student debt. Those are crowd pleasers. And because of this very long, protracted period of low interest rates, the government's been able to get away with it, but they can't anymore. So I would say a pox in everybody's houses. There's just an inflation bias in Washington.